Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference. And I'm here with Karen Schenone, Fixed Income Strategist at BlackRock. Karen, welcome.
Hi, Tom. Thank you.
Thanks for being here. So, for the average advisor, as they're looking at the second half of 2016, on the fixed income side, what do they need to be concerned about?
Yeah, I think this second half of the year is going to be really interesting. So we've got a potential Fed rate hike, we've got a U.S. presidential election, and we've got the search for income going on.
Right.
So I think for the average advisor, they just need to be really cognizant of how much credit risk they're taking on, how much interest rate risk they're taking on, but at the same time they want to keep their portfolio construction, their bonds versus stocks, right on track.
So for the last 3 years we've been talking about rate hikes, we've talked about rising interest rates. It really didn't happen, and those
right.
that kept the risk on were rewarded. Will the next couple years be that way?
I think we're probably looking at potentially one rate hike later this year. Right now there's only about a 40 to 50% probability of that happening.
Yeah.
But we could probably see a little bit of interest rates coming up on the front end. But we think we're going to be lower for long on the long end of the curve. And why do we think that? Well, because a lot of bonds globally are negative yielding. So that's causing more and more foreign investors to come to the U.S. to buy fixed income. And that's keeping prices high and yields low. So I think while we could get some increases in interest rates, we're probably not looking going back to a 7-8% interest rate environment by any means.
And as far as the election, we've got a bipolar group of candidates here, right? So there's going to be a whole group that's going to get really excited and a whole group that's going to get disappointed. Could this either way put shock waves for the market?
I think so. I think you could see, depending on how the market reacts, the market does not like uncertainty.
Right.
And I think this is just causing another layer of uncertainty in policy, in the direction of the economy, and what new programs might be implemented. So I think that we'll see a lot of investors continuing to just hide in treasury bonds until it blows over.
Okay. So instead of hiding in treasury bonds, you have a lot of selective fixed income ETF strategies. What are some things that, as you talk to advisors, they're moving money towards to maybe head off some of this risk, but also take advantages of some opportunities?
Yeah, I think we're seeing a lot of people just rethinking fixed income and adding a little bit of duration back to their portfolios by even buying a core vehicle like AGG. We're seeing a lot of advisors still sitting in cash. And then they're trying to get that money off the sidelines by maybe investing in a short maturity or short duration ETF like NEAR, like Float. And then we're also seeing just the search for income. High yield ETFs, preferred stock ETFs, emerging market bond ETFs, those have all been very popular this year.
Right.
Yeah.
So there are plenty of choices, that's a good thing, but you have to have a strategy, right?
That's right.
Okay.
That's right. So we see people building income portfolios and just trying to stay diversified, because while we can try to predict what is going to happen on the interest rate front, probably forecasting rates has been one of the hardest jobs in finance for the last 30 years.
Yeah.
But I would say that if you just keep your portfolio construction on track with that mix of stocks and bonds, and really think about how much risk you want to be taking, that can really serve you well going forward.
Absolutely. Karen, thanks for the advice.
Thanks
Great
for having
seeing
me here.
you.
Appreciate it.